Friday, February 22nd, 2019, Maneco 64, home of alternative economics and contrarian views. This morning I want to talk about interest rates, the bond market, and derivatives. I've spoken about derivatives before. I used to work as a futures and options broker in the City of London for 20 years. Futures and options, of course, are a kind of derivative. They're traded on exchanges, but there's a whole bigger sector for derivatives called the over-the-counter derivatives, which is traded on the phone between big clients, big banks, amongst banks. And I'm going to show you how derivatives is like the tail wagging the dog, so to speak. There's Billy. It's what keeps the system, this debt bubble going for now. And I'll prove to you how and since when that has been the case, and how they're able to keep interest rates artificially low and to keep the price of gold also artificially low. So before that, of course, let's have a quick look at what the markets are doing this morning. It's 8:06 a.m. London time. We've got spot gold 1326.30. So we're up about 3 from the close yesterday, but down about $13 to $14 since I made my video yesterday. Am I concerned? No, not at all. Silver 1589, up about 9 cents. Range has been 1592 to 1577. The range in gold, by the way, has been 1323 to 1327. So we're near the highs here of the session. The Dow is up 7, 25,861. I think we closed down about 100 yesterday. We were down more earlier. S&P is unchanged, 2775, so fairly quiet. NASDAQ 100 future down 1 point. Not really much activity right now. The pound or cable is 130.33, down about 5 pips. Euro's up 8 pips, 113.42. Dollar yen 110.74. That's up 4 pips. The dollar versus the Chinese currency is down about 0.07%. So fairly quiet here this morning. Crude oil 57.08 WTI and Brent 67.15. What about the bond market? Sorry. Well, the 10-year yield's at 268. So hasn't really moved that much this week. Not much volatility at all. Not good for people like me, futures and options brokers. My market was the bond markets, government bond market. So if the market doesn't move, don't do much business. The 1 year to 5 year spread is about 4 basis points. So that's kind of narrowed a little bit. So interest rates, the bond market, the debt bubble that we're under, and no one can argue about that. Look at this national debt clock. It makes you go dizzy when you watch this debt clock. And of course, GDP is growing, but not as quick as the debt. The debt, as you can see, the deficit is almost 5%. GDP would need to grow by more than 5% to keep the debt from growing. So what's keeping this debt going? Because a lot of times in the past, I've thought, if we've got so much debt, you look at emerging market countries, when they accumulated a lot of debt, the markets punish them and interest rates go up. And I thought, how can we keep interest rates in the US, Western Europe, UK, Japan, the Western countries or the hard currency countries, how can interest rates stay so low? I mean, in Europe, they're even lower than in the US, even for countries like Italy and Spain. And there's only one explanation, in my opinion, It's the derivatives market. And you can see here how important it is. You've got this chart of the 10-year yield, US 10-year yield, going all the way back into the 50s. And since 1981, when it topped almost at 16%, it's been going down. Lower lows, lower highs. And recently, last year in November, we got up to almost 3.2%. We broke a previous high, and you can see how now that yield is dropping. The Federal Reserve, the powers that be, they thought, oh, let's try to normalize things. And you know what happened when they tried to normalize things. Letting interest rates rise to its natural level while the market started imploding. We had the stock market crash in December all the way until Christmas Eve. And then we had President Trump trying to, he turned things around by threatening the Federal Reserve. So Donald Trump wants to keep this debt bubble going for some reason. How can you make a country great? An indebted country. All you're making is future generations more slave than free people, because that's what the national debt is. And what are derivatives? Well, derivatives are basically side bets or bets, very leveraged. That's the thing you need to understand. And I recommend you watch the movie The Big Short or read the book. I'm not sure if there is I think there is a book. You need to read The Big Short. They explain really well how derivatives work. Basically, they are leveraged bets that stay off the bank's balance sheet. That's the other thing people don't talk about. It's off balance sheet. And there's two kinds of derivatives. The ones that I used to trade, exchange traded futures and options, that people can, the public can keep track of because the data is publicly disseminated. But then you have the over-the-counter derivatives, which are basically a casino run amongst the banks, amongst their clients, and big corporations, even governments. We know that Greece wrote OTC derivatives with Goldman Sachs in the beginning of the century, and you know what happened to Greece. They went belly up because of those derivatives, right? It's basically, in the bond market, it creates artificial demand for government bonds, corporate bonds, all kinds of securities. So it keeps interest rates low. Yes, of course, sometimes the banks come out, oh, we think the 10-year yield is going to go to 4 or 5%. That's just for them to pretend, in my opinion, that there is, there is a real market out there. They know, the JP Morgans, Goldman Sachs, Barclays, they know that if rates go that high, everything will implode, and so will their own banks. But just like to show you this chart here of the growth of derivatives. And notional amount just means the underlying size. That's where the leverage is built. Let's say in gold futures, for example, with 5,000 pounds or $5,000, sorry, you can control $130,000 worth of gold, right? So that's the notional derivative. You can see here, this is from 1990, how small it used to be, derivatives. And this is for US commercial banks. And you can see that the growth of it has been after 2000. What happened in 1999? Well, they repealed Glass-Steagall, and commercial banks in the US could not do this prior to that. And this has been the major reason why we are where we are right now, and they're able to keep the debt growing. So why did politicians allow that? Well, because it allows the politicians to keep spending because interest rates are low. You can keep increasing the national debt, keep increasing government spending, and running deficits like there's no tomorrow. But so that's where this is until 2014, this chart. And I'll show you another one now. This is from the Office of Comptroller of the Currency. So it's a U.S. Treasury institution. You can see that it's still above 200 trillion. So the growth of it is still there. And the other thing they've done after the crisis, the accounting of these derivatives has changed, and it allows the banks actually to underestimate how much they have. So how did some of the U.S. banks have derivatives prior to 1999? Well, they used to operate outside the U.S., and there are ways around it. But, once Glass-Steagall was repealed, that's when we really had the big bubble, and we're still in it. And one of the major beneficiaries, of course, was Robert Rubin, who was Clinton Treasury Secretary. Before that, he was CEO of Goldman Sachs. And who benefited from Glass-Steagall being repealed? All the big commercial banks like Citibank was able to merge with investment banks. And where did Robert Rubin go to work after he left the Treasury and left the Clinton administration? A few years later, he went to work at Citigroup, and all he did was sit in an office and have a title. And they bailed Citigroup out in 2008, 2009. And I think he walked out with hundreds of millions in compensation. Well, that's how you pay people back in this system. You employ them, you give them an advisory role, right? So that's Robert Rubin, who is in the Council on Foreign Relations, I would, add. So what about the banks, because people go on about Deutsche Bank. Oh, Deutsche Bank has got all these derivatives. It's, the European banks, the American banks are doing well. But, this comes from the OCC as well. And look at JP Morgan. They've got 70, this is the latest data, Q4 2018. JP Morgan's got 75.5 trillion of derivatives, while U.S. economy is 20 trillion. Go figure. Citibank, 48. Goldman Sachs, 40 trillion. So all I'm trying to say is that don't be fooled by this talk of European banks being like in trouble. Well, they are in trouble, but American banks will be in trouble as well very quickly if things change. What kind of derivatives are there? Well, you can see here interest rate and FX and gold derivatives. So this is really important. The interest rate is how they keep the bonds under control, and that's the orange and the blue and the gray. That's the interest rates. So you can see how huge that is. Since 2001, it's grown, from 25 trillion to over 150 trillion. So that's how they keep the bond market under control with these derivatives. And then below you can see FX and gold. And this is how they keep the gold market and the foreign exchange market under control. And you can see how it's still growing, these derivatives. And then I'll show you one of gold on its own. And this is not just COMEX gold, but it's also OTC swaps for gold options amongst the banks. And you can see how much it's growing from 2001, getting even bigger. The derivatives market on gold. So what's gonna change things? Well, this is not a game that they can play without any danger. The danger is the leverage. And like Jim Rickard said, a little snowflake could trigger a huge crisis. And nothing has been done since 2008. If anything, this derivatives Ponzi is still around. It's bigger than ever, even though we're told it's not. Globally, I would say it's over a quadrillion, which is 1,000 trillion. And you can see what happened when interest rates started going up last year. The 10-year yield above, almost up to 325. They had to the Fed had to backtrack. So what's this mean? It means that the rates are lower now. They're gonna, the system gonna be able to increase these derivatives even more, but they're gonna shoot themselves in the foot. So as I said, the way to protect yourself is to be out of this system as much as possible. and not play this game. If you want to play this game, go to Vegas, but I don't recommend it. So if you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet, and make sure you also hit the notification bell to be notified of my videos. You can also follow me on Twitter, Steemit, and DTube. Wish you all a great day. Take care. Bye.